Hi, my name is Andy, and I work at Visible Alpha in the buy-side account management team, covering clients in the UK and continental Europe. Today, I'd like to highlight a story about TechnipFMC, which is a UK-based company providing oilfield services. They operate in three different segments: subsea, onshore, offshore, and surface. TechnipFMC published their Q2 results on the 25th of July, and these results were mostly a mixed bag. However, the market reaction was quite positive. So I'm going to break down these results and try to highlight some elements to better understand why the reaction was so positive. Let's have a look at first at the income statement. What we can see for the Q2 revenue figure is that the consensus estimate had been mostly in the $3.2 billion area over the past year, whilst it finally came out at $2.9 billion, which obviously was a disappointment. The pattern is actually similar on the net income front. We can also have a look at the figures across the different business lines. What we can see is that in the business lines that had been traditionally the most significant for TechnipFMC, the figures came out at levels that were below the levels of 2017. However, the lone bright spot can be found in the surface technology space. The revenues came out above $400 million, which represents an increase by more than a third on a yearly basis. But the most significant silver lining is not to be found in the revenues or profit figures. We can have a look at the figures in the order space. And what's interesting to note down here is that TechnipFMC recorded strong inbound orders. The orders for Q2 came out at $4.2 billion. And if we have a look at the estimates for the remainder of the year, what we can see is that the figures should come at levels that are far above the levels from 2017. We can also break down those figures across the different business lines. For the subsea space, what we can see by running a surprise analysis is that the orders continue to surprise to the upside. As you can see from this green shading across the past quarters, orders came out at levels that were consistently above consensus estimates. We can have a look at the figures going forward as well. And what we can see clearly is that the revenue for the end of the year is expected to be at $5.8 billion for the subsea space and should mostly keep on increasing across the year. And if we have a look at the book-to-bill ratio, it is supposed to come out above 1, which, if confirmed, would be the first time in 4 years that the size of the order received is above the size of the orders billed for the subsea space. Those orders figures are all the more surprising given that FMC Technologies received only 3 mid-sized contracts in the subsea space, which suggests that they are doing very well in the smaller contracts. If we now have a look at the onshore-offshore space for the orders, what we can see is that the orders came out at $2.3 billion for Q2, which represents a spectacular increase to where it was a year ago. And orders are expected to have a continuously strong growth rate on a yearly basis for the quarters to come. So those figures in the order space, which are quite impressive, do set it up for future revenue growth, which is why we had such a positive market reaction. That's it for today, but let us know if you have any question. Thank you.